Okay, so who is Larry Gaines? Larry Gaines helps individuals generate greater income from their investment capital with less risk exposure. He founded PowerCycleTrading.com and the Power Cycle Virtual Trading Room following over 30 years of professional trading experience in the commodity and equity markets. During his tenure as head of an international trading company that often traded $1 billion worth of commodities in a single day, he learned firsthand the necessary elements of a successful trading system and the use of options. Using this in-depth knowledge and experience, Gaines developed the Power Cycle Trading model to allow for greater profits with a more disciplined, systematic degree of trading success. Today, Larry's going to be showing us a 5-step plan for options income success. Larry, it's all yours.
Well, thank you very much, Kevin, and appreciate everybody being here today, TGIF. Let me just make sure I'm set up here properly. One second. Looks good. All right, so just double checking everything. Okay, everything looks good. You guys can hear me okay? Everything sounds coming through okay? Looks good from my end. One more thing I want to check. Okay, so yeah, so we're going to go through. I'm going to go through my 5-step plan for option success with you guys today, and one of my big passions is option trading. So let's get rolling here. First off, the following webinar is purely for educational purposes only. Any stocks or futures or options mentioned does not constitute advice and should not be construed as recommendations. So, yeah, appreciate your introduction, Kevin. Yeah, I've been an active trader for over 30 years. Previously, I was the executive vice president for one of the largest oil trading companies in the world and ran their international trading desk out of Bermuda for over 10 years. Which was a fantastic experience for me, great learning experience, and a great lifestyle change too. Living in Bermuda wasn't too bad. So, you know, we started out in crude oil, but we expanded out to all the different other areas, all the various futures markets, and ended up doing a lot of Forex too, just because of the size of the market. We were also one of the first groups to trade over-the-counter options on crude oil, so I traded millions of barrels of those and started doing that back in the mid-1980s, and that's kind of where I really got introduced to options and just, you know, been into options ever since. I also then went on and I opened up an institutional over-the-counter crude oil option brokerage desk for the largest privately owned oil brokerage company in the world, PVM Oil, out of London, and that was also another great, actually, learning experience, doing all the various structures with the institutions, banks, and hedge funds. So a lot of background in trading, a lot of background in options. But you know, one thing I do want to always, when I do a presentation, I always like to get a feel for the people that are in the room and just to see where you are within your trading. I'd like to just, if you just put a yes or no onto how many of you would like to be trading, you know, as a major part of your income, or maybe even a full-time job, but maybe you're just not quite there yet with your confidence level or your knowledge level. I just like to get a feel for that. I can't really see the question side, but I'm going to assume that a lot of you are interested in getting into trading as more of a full-time presence. So now, you know, again, I've been trading for over 30 years, but most of my trading, it started out as kind of OPM, other people's money. And what I found out was that trading OPM is way different than when you're trading your own hard-earned dollar. So I had some major learning experiences trading my own account. And, you know, when I first started doing that, and some were not too pretty, but, you know, you do learn from your mistakes. And a lot of what I teach is, you know, from things that I've learned from my past mistakes. Now, trading my own account really started to improve actually once I started doing a better job of controlling my risk. And the huge breakthrough for me was learning how and committing to limiting my downside in any trade taken. And I do this by using options and option spreads. And the really big aha trading moment for me actually came when I started taking advantage of option premium collection type strategies. When I started incorporating that along with the other trading that I was doing, it really helped me to smooth out my my equity curve. And once I committed to this, then, you know, I could actually be a lot more relaxed in my life and sleep a lot better at night as well. So, you know, I just kind of wanted to put that out there, and I want to go through everything that I've learned from some of the experiences I've had, and I'm going to pass some of that on to you today. So I'll try to get through this presentation and then take as many of your questions as I can at the end. So let's get started. So we're going to go through here a 5-step plan for option income success. And the first step is how to embrace risk for trading opportunities. The second step, avoiding that #1 option trading mistake. Step 3, most important option factor. Step 4, how option pricing works. And step 5, highest probability option strategies for every market. So the first step, though, is how do you embrace risk for your trading? Now, trading is about managing uncertainty. It's about probabilities, and the fear of uncertainty can kill an account. But if you shift your approach from choosing to manage risk instead of uncertainty, you will create an account winner. So I always tell my clients and my members to do embrace risk, understand what the risk is, and it's going to provide you opportunity if you know how to deal with it. So how do you deal with this? Well, first you need a kind of a trading plan. So you want to choose your own risk limits. Everybody's going to have a different size capital account, different amount of money, different times of day that you might want to trade, different lifestyles. So you need to set aside what are your risk limits. You also want to own the accountability for your trading decisions. You want to understand the risk with the strategies you choose. So don't go into anything blindly, and I always recommend start out paper trading or trading very, very small volume until you get familiar with the kind of the rhythm or the risk of whatever you're looking to trade. And then know how to defend any trades you enter within a chosen risk parameters. So, the more you know about the certain strategies you're using, then you can develop ways to defend those, and you should always have that going into your trades. Now, you want to also choose trades that have defined risks that meet your guidelines, because you're in charge, and it's your responsibility, and you're accountable for it. So step 2 is avoiding that #1 option trading mistake. And option trading has many more advantages than trading stocks, but it's a bit more complicated. And for the somebody just starting out or the newbie, it can be a little bit intimidating as well. That's why many investors decide to begin trading options by buying short-term calls, especially those out-of-the-money calls where that strike price is above the stock price. And it's the familiar pattern usually is buy low, buy cheap, and sell high. So that's been kind of ingrained in our mentality for years and years and years. Now, this is an example to kind of show you this point, is that imagine you're bullish on stock, and we use Facebook, and it's trading around $65. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of $80 that would cost 15 cents or $15 per option contract. And when you look at that, that's very, very tempting, because you look at the price of those options, and you can look and see you can buy lots of them. So let's do the math, and remember, one option contract will control 100 shares of stock. So by purchasing 100 shares of Facebook and you pay $65, that would cost you $6,500. But the same $6,500, then you could figure out, well, with that money I could buy 433 contracts of those 80 calls, and doing the math, you would control over 43,000 shares. So you're thinking, that is tremendous leverage, and if I get it right as far as direction and price, I can make a lot of money. And then you look at Facebook and you say, okay, well, if it hits 81 within the next 30 days, and those 80 calls then are trading at $1.05 or $105 per option contract, I can make over $38,000 in a month. And that is, huge. So, you're looking at that. Well, if I did that every month or every 2 months or every quarter, I could really be raking in the cash. And so at first glance, that kind of leverage is awesome. But, don't let the glitter fool you. So, one problem with short-term out-of-the-money calls is that you not only have to be right about direction the stocks move, but you also have to be right about the timing. And that really ratchets up the degree of difficulty. To make a profit, the stock doesn't just need to go past your strike price, but also must do it within a defined period of time. Now, in the case of those 80 calls on Facebook, you would need that stock to reach that $80 within 30 days to make that profit. So you're asking the stock basically in this example to move more than 23% in less than a month. And in options, this would be, in this kind of example, this would be like a 2 standard deviation move. And there are not that many stocks that are likely to do that. Now we will, see those type of moves, but it's not that common. And so there are not that many that'll do it. In all probability, the stock would not reach the strike price, and those options would expire worthless. So based on the probabilities, and we use probabilities of standard deviation with our option trading, there's only about a 5% chance for this stock in this example to reach that $80 by expiration. So in order to make money on buying, strictly just buying the out-of-the-money type calls, you either need to outwit the market or just really get lucky. So being close is means no cigar. Now, so imagine the stock rose to 75 during this 30-day period. Well, you could pat yourself on the back about being right about direction, but you're still going to be wrong about how far it would go within a specific time frame, and you would still lose your entire investment. So based on this newbie option trader mistake, in my opinion, a better goal for every trader would be to select trades based on what provides the most consistent positive returns. Having a consistent return will really, grow your account a lot faster and smoother. And one of the best ways to achieve this is by using option strategies that take advantage of selling options for income generation. By selling options, we're in essence kind of selling time. An option is like a coupon that must be redeemed by expiration date, or else it's going to be, the validity of it's no longer there. So how's this done and what's involved? Well, step 3 is just looking at that most important option factor for income generation, which is, time. Now, time value is used for, trading strategies that take advantage of this accelerated time decay of an option to its expiration. And option income strategies are very, very tied to time value and the impact that it will have on the price of an option. So what is time value? Time value, or extrinsic value of an option, is the premium a rational investor would pay over its current exercise value, which is the intrinsic value based on its potential to increase in value before expiring. Now, this probability is always greater than 0, thus an option is always worth more than its current exercise value. So time value, or time decay is exponentially goes to 0 at expiration, with a general rule that it's going to lose about 1/3 of its value during the first half of its life and 2/3 in the second half. So as an option moves closer to expiration, moving its price requires an increasingly larger move in the price of the underlying. So you're basically, when you're buying options, as you get closer to expiration, you're really swimming against the current. So it's more difficult for you to make money in a lot of situations unless you have that really powerful move in the direction of those options that you've bought. So here's your typical time graph to kind of illustrate this point. When you buy out 120 to 90 days out, the time decay, or theta decay, is very, very slight. So it goes down very, very low, maybe a penny a day. As you get into 60 days out, 30 days out, then that theta decay will go 2 cents, to 5 cents, to 10 cents, and then you're eventually down to 0. So it really starts to fall off, and you really get hit hard with time decay or theta decay of your options. So that's something that you need to be aware of if you're going to trade options. So the step 4 is then, how's option pricing work? Well, the value of an option is time value times its implied volatility times the intrinsic extrinsic value. And once you know these variables, then you're ready to price an option and know what its option premium should be. So implied volatility, well, what is that? It's what the market is implying the volatility of the stock will be in the future based on the price changes in the option. And then you've got that intrinsic value, that's the amount of money, the amount an option is in the money. And then you have the extrinsic value, which is the price of the option less that intrinsic value. So that's the out of the money portion and that's how those are the variables that you really need in order to price the option. So here's just a simple table to kind of bring that a little bit more clearly to you. So this is based on a weekly option series, and every Thursday you get a new series. So it's the time value times the implied volatility times that intrinsic extrinsic, that will equal your option premium. So in this example, I kept the intrinsic extrinsic at a constant of 1, so we can go through the math. So you start out Thursday with full time, and you've got implied volatility at 300. So it makes your premium $300. So then you can see, though, when you go to Friday, you can see you're dropping by an eighth, and same volatility or implied volatility. So you can see your premium then goes down. When you come into Monday, we come in Monday now, you'll see that even when the implied volatility spiked up in this example to 5 to 800, you still barely got a pop on your premium, and that's because of that time decay that you're getting on these options, which do eventually go to zero. So you need to be aware of that, and if you can, then take advantage of it in your trading. So step 5 is selecting the right income strategy. Now the goal, in my opinion, of every trader really should be to select trades based on what provides the most consistent positive returns. And one of the best ways to achieve this is by knowing the income option strategies that are available, and then selecting the one that is best for your trading style or your trading plan. And remember, everybody's going to have a different kind of capital account, and we're all going to have different lifestyles. Some of us are, maybe you're working full-time at another job and you can't sit at your desk all day trading. So by understanding some of the strategies that are available, then you can, select those that are better suited for you. So the income strategies, the basic ones are 5. There's the covered call, calendar spreads, diagonal spreads, long iron condors, and credit spreads. These are the general ones that are out there. Strategy 1 is probably one that you've maybe used a lot, or maybe you've heard of before, and that's the covered calls or puts. And for monthly income, writing a stock option is the basic component of this strategy. When writing stock options, the premium from the sale is deposited straight into your account the next business day. So you keep that premium regardless of what the stock option does in the future. And I tell my clients and members, the easy part is selling and collecting that premium, but the hard part is keeping the premium. So that's really kind of the battle at times, is keeping that premium. Now, stock options times compounding really can create some great wealth, and cash from writing stock options will compound into great wealth. And so, if you understand that, just the simple principle, if you had a 5% gain every month, it can really make you rich from the wealth building power that compounding offers. Now, most investors, though, overlook the wealth building aspect of the compounding that gives you, and they simply just look to purchase stock with the hope of it increasing in value. While the stock option writers have increased their returns significantly, the traditional investor, though, still a lot of times waiting and hoping for that big upward stock price move, which we've probably all been through in our careers of trading or even investing. So if you take the simple example of writing stock covered call options in a self-directed IRA, and you were able to get a 5% gain each month, mathematically you could take $978 investment and you could grow that to over $340,000 in 10 years. So that's the big power of income, and then compounding that income. In contrast to that, if you took the same amount of capital and you're just getting 2% interest, then it's going to take you 100 years to reach that 300,000. So stock covered call options, and an IRA can really provide a way to make up for years when your retirement fund didn't grow fast enough, or not at all, or a lot of times it goes down. So this is something that you should be aware of and consider having as part of your portfolio. Now, covered calls versus covered puts. In a market that is strong, you want to write covered call options. you're basically treating the stock as commodity, and you trade it to generate income each and every month. Just like if you have rental property, you're waiting for that rental check to come in each and every month. It's not important to want to own the stock the options are written against. It's actually to your advantage if that stock's called away, because then you're going to keep that premium. It's important though to like the stock's short-term potential and select those stocks that are going up, because that's an important part of it. Now, writing stock covered call options is a great source of income when we have a strong market. But what about times when the stock market is falling off a cliff or going down? Well, if the market's weak, a couple things you can do. You can go to cash and go to the sidelines, but if you're looking for the income, you really can't do that. So the other thing you can do is you can write stock covered put options. Writing a stock covered put option, this allows you to profit from a declining stock market. With the stock covered put option, you've already sold that stock short, so you don't care if it drops. You want it to drop, and you've sold then a put against it to collect the premium and income off of that. But the other option income strategy in a weak market is to write covered call options on inverse funds, bear market ETFs, and this is my preference. And this is a list of some of the good ones out there. There are a bunch of different ones you can choose from. But when I'm writing premium on ETFs, I'm looking for ultra, double or triple to get that extra premium. And these are the inverse type of ETFs you can choose from. You can have the QQQ. This QID is a really good one. I like that. The SDS is the S&P 500. That's a very good one. And the TWM is a really great one on the Russell 2000. So, between these three, you have a really good vehicle for, trading in a down market and doing a covered call type of trade setup. So these are things that you should look into if you're looking for a mechanism or a way to participate in a down market using this strategy. Now the second strategy that is used is the calendar spreads. The calendar spread is a neutral option strategy that profits when the underlying stock remains stagnant or trades within a tight trading range. And the calendar spread, profits primarily, it's a timing spread, so it'll profit from the difference in the rate of premium decay between that near-term short option that you're going to be short and the long-term option that you're long, or a leap that you're long further out to take advantage of the slower time decay or theta decay. Now this is possible as that near-term option premium, as you know, will decay a lot faster than the long-term option premium. And this is what it looks like if you put it just on a time graph. So what you're going to want to do, let's say you're trading Microsoft or whatever, and it's $30. So you're going to look to buy the $30 call 60 days out, or you could even go further, but usually about 60 days. And then you're going to short the $30 call that's a shorter expiration 30 days out, or you could even do it shorter with the weekly options that are available. Now by doing this, this option that you bought 60 days out is going to have that very, very slow drip time decay, maybe a penny a day, versus selling the 30-day option, you're going to start getting that really fast time theta decay, 5 cents and more. So that's the concept. And then your short duration option goes to zero, and this one is not affected much, so you have that difference in the timing spread. So it's a really good strategy. It's a really good strategy in a sideways market or a market that's gradually moving up, and it's a good income strategy to consider using. And these are strategies you can put on, and you don't have to be there each and every day watching over it to manage it. Now the third strategy is the diagonal spread, and this is a version of the calendar call spread as well. The difference is that you purchase an in the money option. Usually you're going to want to purchase a leap option, which is your longer term options that are out a year, and they could be out even 2 years. And then you're going to sell an at the money or out of the money option against it near term, just basically like you do a covered call, except you're not going to own the underlying stock or ETF. Instead, you're going to own the option, which will be a lot cheaper. So here's an example of the trade that we did earlier in the year, and this was when oil was starting to bottom out And this is a really good strategy when you find a market that's starting to cycle low and bottom out and then turn. So you want to do it on that kind of market, not a market that's already had a big move up and then might look to move again, because you don't want to get caught in a situation where it rolls over on you. But in this example, oil was bottoming out. This was back in January. So, you could use the USO ETF. And so at that time, it was trading around $35. So went out and bought the January 2015 $25 calls, and then sold the April 2014 $35 at the money calls against it, collected 60 cents or $60 a contract. So this works exactly like a covered call, but you're long the leap option, so you can take advantage of the leverage. So this is what it looks like. So here it is again. You've got the 35 April call. You sold. You collected $60 an option contract. You went long the January 2015 USO 25 calls at around $10. So that's about $1,000 per option contract. So your debit is $1,000 less the credit you received, $60. So your net capital at risk is $940. Now, if you look at this example versus if you just went ahead and bought the USO ETF itself, in this situation, you're still, still selling that 35 call, collecting $60, but you bought the shares instead. So you'd have to buy 100 shares to make it equivalent to one option. So that's going to cost you $3,500. So your debit's $3,500 less your credit that you got from the April call that you sold of 60. So your capital at risk on this 100 per 100 shares is 3,440. So you can see the difference. Your capital at risk there versus there, you get a much better, more favorable return. Here you receive a 6% return, and here you only get a 1.7%. So if you get the right setup, it's a really good strategy, and you can write these several months in a row. And then what you want to eventually happen is that stock to go up, and you don't write it anymore. So you collect income while you're waiting. It's kind of like a warehousing type of setup. So that's the diagonal spread. And then the fourth strategy, and this is my favorite because there's just so many different ways that you can use these, is just the credit spreads themselves. And the basic credit spreads, you've got the bear call credit spread, bull put credit spread, and long iron condor. So the bear call credit spread, this is, for a bearish bias. You're basically long a call while simultaneously short a call with a lower strike and in the same month. And then the bull put credit spread is a bullish strategy where you're short a put while simultaneously long a put with the lower strike in the same month. So you've got an insurance. By doing a spread, you're insured not to lose but a fixed amount of money, which would be the spread less the credit that you receive. So it's a limited amount of risk for a limited amount of gain, but it's a great strategy and can be a very low risk, high probability type trading strategy to use. So it's a low cost kind of directional play. Now, when constructed properly, the spread is an excellent premium collection strategy. So the other side of that is the long iron condor, and that is just strictly a combination of the bull put credit spread and the bear call credit spread together. So these should be equal distance between each strike price, while the underline should be between the two credit spreads or short options. So the long iron condor is just these two spreads together. So you might be short, let's say, a $400 call, and then your insurance is to be long the 405 call. So it's a $5 wide spread, and let's say you collect $100 premium for selling that 400. So in this is a bearish bias. So as long as the market closes below 400 at expiration, you keep that $100. Now the other side is if you do the iron condor, then you'd be selling the put side of it. So same distance, the 390 put, sell that short. And then for insurance, you buy the put below it. In this example, we'll use the 385, so you have a $500 wide spread, and let's say you collected $100 there. So if this closes above 390 and below 400 at expiration, you're going to get $200 profit on this. And these type of strategies are great for a sideways market that's just kind of taking its time, consolidating up and down like this. So it's a great strategy, but it's something that you don't use all the time because you don't want to be doing a long iron condor and then have one side get breached and get you out. So there's certain situations for that, but it is a really good strategy to use. Now, short vertical spreads and credit spreads, when used correctly, will provide the trader or investor the greatest probability of success and are one of the best ways to generate a steady stream of income. Now, market makers that make the market for the options use the implied volatility of an option to set an option price and also to forecast the expected implied move of a stock or security up and down by the expiration of a specific option series. Now, this is referred to as a one standard deviation move as the basis that's used. And it's based on statistics of this, what you're seeing here, a normal distribution curve. And this is of a probability of, say, a stock pricing between 2 points. Now, by using the implied volatility of the underlying, you can calculate and forecast its price movement over its option life. And this becomes a really very useful trading tool for determining price targets to trade against. And the really great thing, cool thing about it too, is it's a free option tool that you get with any platform. So in this example here, this is a normal price distribution curve that illustrates a one standard deviation move between these two arrows. That's a one standard deviation move in this example, based on time to expiration. So, you know, and this will be a 68.2% probability that the price in this example will close between 480 and 520 by option expiration. So the probability of the trading, you know, it's got this 68.2% probability trading between 480 and 420, and only a 16% probability right here of trading above that, or a 15% or 16% probability of trading below that. So this information is given to you on every option platform. It's all free. You can get it. So in this example, it's just looking at a one standard deviation plus or minus 4% by expiration. Say if this is 10 days on option expiration, then the market makers are forecasting that the stock of this will be, let's call it Google, by expiration will close somewhere between 480 and somewhere between 480 and 520, or 68.2% of the time, or one standard deviation. So if you play these type of probabilities and odds, then you can structure your trades. So are you going to want to you know, be buying these options that are maybe 520 or 530? If you're doing that, you can see by buying the higher strike options with that have a lower probability of success, you're going to probably lose money more often than not. So based on the math of probability, you can see why 70% of options bought expire worthless, and why it's a good idea to consider selling options as well as just buying. Now, I buy options, but I also constantly look to sell options just to diversify my risk. So it's a really good way to smooth out your risk. It's not something that you have to do 100%, but it's something that really can complement what trading you're doing or even investing. So here's a really good example to show this. This is Wynn Resorts, and these are two different strategies, one and both for a bullish bias to the upside. And the first is your typical strategy of buying directional calls, and the second one will be selling a bull put credit spread. So you're going to see the big difference between the two. And this was on May 1st, and at that time Wynn was trading at $207. So the strategy one was just to buy the at the money June 207 calls. They were going for $1140 or $1,140. And then the second strategy was selling the out of the money bull put credit spread, which was below Wynn's prior low of $189, and you'll see on the chart when I pull it up, and that was a 9.5% below its trading price at that time of 207. So here's strategy one. You can see you have directional, your max potential loss would be 1,140, and you can see the return is infinite. I mean, that's the great thing about buying directional options. You have defined your risk, and you have unlimited upside. But this is an expensive option. You could still lose 1,140 or part of it pretty fast. So this is to illustrate the point here about what happens when the market does come off. So this was on May 8th. Win went down to $196. So here was the original time on the 1st when it was put on, and it was bought at 1,140, and then you see here on May 8th, right here, the market fell off hard, and win came down to 196, and at that point in time, you can see the open P&L went to minus $583 per option contract. So that hurts. So then I'll show you the next slide will be as it goes to May 21st, right here, it actually comes back up and is only trading $2 below where the initial trade was put on. But you can see here that it's still down $518, even though it's trading at 205, which is just $2 below where it originally was put on right there. And now it's here, but it's still down $518. Now that's strategy 1, just buying directional options. And then strategy 2 is doing a bull put credit spread, and this was selling the 187, let me show you here, the 187, 182 bull put credit spread. So here is win on the 1st right here. You can see the prior low is right there at 189, and this strategy was selling down here the 187 puts, collecting $513, and then for the insurance you bought the 182 below it for $383, which gave you a max profit, gives you a credit you received of $130 right here, and the difference between the spread of 500 gives you your max capital at risk of $370. So you know your defined risk and defined profit, and that's still, if it closes above your short strike of 187, you'll keep that full premium, and that's a 35% return on your capital or margin that's put up. Not a bad return. Now here's what happens in this situation with the bull put credit spread. You can see that wins at 196. The directional options are down 583, but the bull put credit spread's only down $38.50. Big difference there. Big difference there. Then you go to the May 21st, when wins back trade at 205, your directional options are down 518, but the bull put credit spread now is in the money, $78.50. So by doing this, you can see the difference in the risk versus doing the directional. Now you'll have a negative risk ratio, but the probability of these trades when you go 1, 1.5, 2 standard deviations out increase the probability of you having a winning trade. So that's what you're giving up return for a high probability winning trades. Now this next example is to illustrate another type of credit spread, and which is really cool, and I love these a lot when you have the right situation. And this is the in the money, kind of a deep in the money bull put credit spread, and it's a bullish strategy. So this particular strategy is when you have a target you think the market's likely to hit. And so for this example, we were looking at Tesla. It was in what we call a volatility squeeze, thinking it was going to break to the upside. Indicators were looking good. So you could have done a lot of different things. You could have bought the stock, you could have bought the options directionally, the calls, or you could have sold a bull put credit spread at the money, out of the money, or in the money. So what you want to do on this is, if you have a target zone which you can place targets, you put your short leg at the target where you think it's going to hit, and you sell an in the money bull put credit spread, and you can reverse that risk from a negative risk ratio to a positive risk ratio. So let's take a look at this example here. So here's Tesla. Here's the trade setup. And this was August 1st. It was traded at 229. And this was a weekly option closing at 248. So the implied move was 4.8%. So that gives your target high of 243, target low 221. So based on that, the structure was to sell a 240, which was inside that projected target, and then buy the 237. So this was actually $11 in the money bull put credit spread, the short leg. So on this particular trade, you were able to get a $217 credit. The max risk was $32.50, so great risk reward. So you've totally reversed that risk ratio to positive by selling deep in the money. And if this thing closes over your short strike leg at 240, the max profit, would be a potential your 217, which would be over 600% return. So in certain situations, these are great strategies. So you can see here the effects that that has when you do and in the money. So here's when it was put on, and this is when it was taken off a little bit before expiration. So that's a really awesome strategy to use in certain situations, and you've reduced your risk. And you can even structure these things as kind of they call it an arbitrage type of bull put credit spread, where you can actually get into these things where there's zero loss if you leg it properly. So a really cool way to play the markets, something that I really like to use a lot, and it's really, these kind of strategies really have helped me smooth out my equity curve and make me sleep a lot better. It's easier to trade and hold positions a lot of times by doing this. So here's that Tesla chart again. So what I wanted to go through here today is how to embrace risk for trading opportunities, avoiding what is that #1 option trading mistake that a lot of people make, most important option factors, how option pricing works, and some of the higher probability option strategies for every market to get you kind of used to what you can look at for your style of trading. Now, I'm going to take as many questions as I can, and I'll answer all those in a few minutes. And I'm also going to tell you how you can learn a lot more about trading credit spreads. But please understand there's only so much I can really cover on this type of subject in 1 hour with basically fire hosing you guys with way too much information. I'd like to say thanks again for having the opportunity here today to share some of my trading knowledge and experience, and hopefully it's some things that will help you in your trading, show you some different things that maybe you haven't looked at, or maybe you should consider looking at in your trading, and go from there. Now, I want to show you, I know a lot of you don't know me, so just if you have a minute or so, read this. I did a webinar. This was on Wednesday night, and this was a comment. I had a lot of really positive comments from some of the people who were there, and this was one of them. So take a minute or so, and if you can, and take a look at that. So, knowing that you're helping, making a difference really is very rewarding. And I don't know if some of you guys here are teachers, you know the feeling when you teach something and you finally get some positive feedback. Sometimes you're not certain, but when you get comments like this, it really does inspire you, make you feel a lot better. So I just wanted to put that out there so you kind of know me a little bit better. Now, what I'm going to go over to is next I want to talk to you about some simple things you can start doing now to generate a more steady stream of income each and every month, and also how you can learn to implement an option income stream. Now, I'll go through this and then we'll take your questions, but basically what I put together for you is a special recorded credit spread workshop that I did just recently to teach traders or investors who are pretty much on any level how to use credit spreads in your trading. It's 100% just on credit spreads. It was a 4-hour course. It was originally going to be 2, and it just, I just didn't get through everything it needed to be, and it turned out it was 4 hours with all the PowerPoints. It's actually over 100 PowerPoints. that will step you through everything you need to know about using credit spreads in trading day-to-day, swing trading, or longer-term type of trading. And it's on demand, so you can keep going back and forth watching the videos. Plus, you're going to get the PowerPoints. And again, it's 100% focused on credit spreads. So if you're interested in here, let me put up the URL if I can. Can I put that up, or can you guys? Let's see. Let me see. Did that? Oh wait, let me put it out there to. Nope. I think you're going to have to put it up, Kevin. I'm
doing it right now, Larry. Give me 2 seconds.
Oh, thank you very much. Yeah, so Kevin's going to put it up. It's realtraderswebinar.com/powercycle. Now, this course is $97, and it's a tremendous value with lots of great content and information. Now, also, if you're not, if it's not something that works for you, send me an email and I'll refund your $97. So it's a win-win situation. Now, the other thing I'm going to do here, just for today, for everybody that's here, so for the first 50 that purchase this course here today, Credit Spreads for Income, you're going to receive an invitation, a free invitation to my new live credit spread course that I'm doing tomorrow, Saturday, and it'll be from 11 a.m. Eastern to 2 p.m. Or more until I get through it. So this is going to be a credit spread course that will go over. I'm going to spend a lot more on kind of how you incorporate in the money type, deep in the money type credit spreads. So it's going to be a really great course, and so you're going to also get invitation of that. So the first 50 will get my credit spread course that I currently have, 4 hours. You can get into that right away, and then you'll be invited to tomorrow's live event, which will also be recorded, and you'll also get all the PowerPoints for that. So it's a great deal. And then the other thing that I like to do is that after I do a course, I will always do an accountability and support follow-up Q&A session, and this will be live, and this will be in about 2 weeks. So once you get through all the material, you're bombarded with content and information, and then you go through that, and you always are going to have questions, and so we'll have that follow-up Q&A. So what we're going to cover in the course is how to use credit spreads to create low-risk, high-probability trades. How to use credit spreads on stocks and index options. I love to use SPX and NDX for these. You can go further out, 50, 60 days out, put these things on and just kind of sit back and watch. How to use non-directional credit spreads and when. And the big thing we'll also be going over is when and how to use those deep in the money credit spreads. Now, these are really great strategies for growing a small account into a bigger account. You can see from that one example on Tesla, when you get the right setup, you can have a very small defined risk and a nice, really big upside. So we're going to also then go through how to defend these trades. I've got 6 defenses that I'll go through on what to do in certain situations to defend and adjust these type of trades when they do go against you. And then when and how to use the iron condors. When should you use it, when not to use iron condors. And then a really cool thing is how to take a 70% probability of winning trade that you start with and turn that into 90% probability of winning. And then a step-by-step guide for executing spreads. Best technical analysis, we'll go through technical analysis such as using Fibonacci, support resistance, implied volatility to set our targets. We're going to go through that. Best market time frames for spreads. How to trade the spreads end of day so you don't have to go bug-eyed staring at your charts and screens all day, and a lot more. So it's a really comprehensive course, and for those that want to sign up, please do using this link, and it's $97, and you're going to get also an invitation to the course tomorrow, which will start at 11 Eastern and go till 2 or 3 until we get this material covered. So all that for $97, and again, I'll refund money if it's something that doesn't work for you. So if it's something that you're interested in, even if you've been trading credit spreads, I've got probably a lot of new things that you haven't used, and if you've never traded a credit spread or even an option, it's a good way for you, low-cost way for you to get into it for $97 and take advantage of my 30 years of trading experience to let me pass on some things that I've learned, and a lot of stuff I've learned from mistakes. So these are things that I've structured around and through the course. So that being said, any specific questions? I've got a little bit of time here. I cannot see the questions. Since I'm not an organizer, can't see the questions unless you want to switch me to organize. Let me see here. Okay, got the questions. Thank you. Yes, I have a virtual trading room. It opens every day from 8 o'clock Central, and it's open till the close. I'm in there from 8 Central till usually 9:30, 10, calling out trades. We do a lot of future day trades to start the day, and then we'll go through option trades and stuff like that, swing trades, a lot of things. Noja, yeah, never traded options. Is this for me? Yeah, I think it is for you because for $97 you got to start someplace. If you're interested at all in options, this is a great place or a great way for you to get started. Now you'll have all this information for as long as you want it, so you can go through it at your own leisure. Take your time. Yeah, question: deep in the money credit spreads. Aren't you concerned about the stocks being called? Yeah, once you get closer to the expiration, that becomes a potential problem. But when you're further out, a lot of times you'll do these credit spreads further out, and they're not going to be assigned to you just because of all the, the time value that's still left in them until you get closer to expiration. But remember, these are spreads, so you get assigned to it. You've got the other part of the spread, so you can just close it out. Or if you want, if you do get assigned and you want to keep the stock, and if you have the capital account set up for that, you can just keep the stock. And it might be a short or it might be a long. So different ways to do that. And a lot of these things, you're not going to have to hold all the way through to expiration. You can take off, at a 50% profit or 80%, something like that. So these are things that that will go through. So, something where you don't keep it into expiration totally, so you don't have to totally be concerned about getting the assignment. Yes, tomorrow's course will be recorded, plus you'll get, again, all the PowerPoints to that course. Question: how do you fix the spread when the market goes against you? So that's going to be covered in the course. I go through, I have six different defensive strategies for different situations to show you that, to teach you that. So a lot of different ways that you can manage these trades, and I'm going to have 6 specific ones that we're going to go over in the course tomorrow. That's also in this course already that's recorded, so you'll have all that at your fingertips. You live in the UK. It's all stuff that you can use for any markets once you learn it. Plus, this is a recorded course, and it's at 10 o'clock Central tomorrow, so that's not a bad time for you in the UK either. I just trade basic calls and puts. Will you cover the basics? Well, if you're trading calls and puts, then you're already kind of up there the learning curve because you already have the basics. So this is something that that will actually complement what you're currently trading. So it's that aha. Once you understand that the probabilities and how you can use those probabilities, then you can see other things you can do rather than just buying calls and puts. Because a lot of times, if you just buy calls and puts, what happens to you? That time decay eats into your premium, and a lot of times you're going to not make money because the premium's decayed based on time. So if you can learn some other things to do to incorporate with your current trading, not necessarily abandoning at all what you're currently doing, but just adding to it, you can help you diversify your risks. So what I like to do is kind of a basket approach where I'll do some directional long calls, but I'll also incorporate doing credit spreads with it to reduce my risk. For your IRA account, the best thing to do is check with your specific broker, because a lot of the different brokers, some are different. Some will let you do some things that others won't. So see if they'll allow you to do credit spreads. It is a spread, so your risk is defined, so you should be able to, but some brokers are more flexible than other brokers. You have a large risk if you see such wide strikes on your credit spreads, don't you? Yes, you do. But that's the that's the key to the credit spreads. Think about it this way: if you take a lot of risk, if you're going to do something risky, you want to get paid for it, right? You want to get paid a really big premium to take the risk. Otherwise, you're not going to take the risk, right? So if you get a big payout for taking risk, you're going to take it. So the problem is, though, if it's a lot of risk to it, a lot of times you're not going to get that payout because of that risk. Now, the deal that makes the credit spread so intriguing is that when you go into a credit spread, if you understand the credit spread, as soon as you go into them, you start out with, the way you set it up, you can start out with a high probability of it being a winning trade. So if you've got a high probability of winning, what's your reward going to be? They're going to lower, it's less risky, so you're going to get less reward. So that's why the risk reward on the out-of-the-money credit spreads are a reverse risk ratio. But if you can have a probability of winning 70 to 80 or 90% of the time, then I like those odds, and I'll take a little bit of less return for that. Plus, you can also defend those. It's not like you're going to sit there and do nothing, twiddle your thumbs. There are defensive strategies that you can do. So the main thing, once you sell an option, you collect a premium. The easy part is getting the money. The bigger part is keeping it. So that's what you want to learn how to do. And yes, tomorrow's being recorded, and the first 50 that get in today, you get into that. So it's a great deal for you. Let's see, I've got a bunch of great questions here. If you registered, there was an upsell, so if you registered, you're probably in. My email address, if you have any questions, I can give you that. 1 second, and I'll give you that too. Let me just get it real quick for you. It's Larry at Power Cycle Trading, and I'll just copy and paste it in there. I think this. So yeah, you can send me an email there, and again, yeah, that URL, and I'll put that in there one more time for you. Hopefully this comes through. Put that in there. Did that go in? Can't really tell. Put it. Wait a minute. 1 second. I think it went in. Went in. It's Larry. You can see it here on this screen. realtraderswebinar.com/powercycle. Let me back up. A lot of good questions here. Yeah, if you are not able to attend tomorrow, that's okay because it's all recorded. So if you sign up here today, you'll still get everything that we do tomorrow in the recordings. And I try to break those recordings down in like 30-minute modules, and then you'll get all the PowerPoints as well. The main Greeks that I look at, will be theta decay and option delta. Those are the main ones until you get closer to expiration. Then the gamma comes in, but I won't spend as much time. Mostly it's just going to be implied volatility, theta, and delta. Oh, thanks, Charles. Awesome presentation. I appreciate that. That's what That's what makes you keep coming back when you get feedback like that. I really appreciate it. Let me see here. Yeah, so the webinar tomorrow, it's basically those things that I showed you here earlier. I'm going to go back through those. We're going to spend a lot of time on the foundation of the option credit spread. And the foundation is implied volatility, how to calculate that, how to use it to structure your trades for setting your targets, and then how to set up the trade based on implied volatility. So a big chunk will be standard deviation, how to know what it is, how to determine that by option delta or by the different ways to calculate it, how to use your option platform, all the free information, and that'll be a big chunk of it. And then we'll go through the structures and defense and in the money, credit spreads, things like that. So I think that's about all I can do as far as time. And I hope to see everybody tomorrow, and I really appreciate Kevin and Mark and everybody having me here today to give you a little bit of my knowledge. Thanks. Have a great weekend.